Is Amazon still a strong growth company for you to invest in right now? In today's video, let us take a look at its fundamentals, and I'm going to walk you through a simple fundamental analysis procedure that you can conduct on any of your favorite stocks, not just for Amazon. In our previous video, we have calculated the intrinsic value for Amazon to be at $5,464. And this may seem like a very crazy number, especially when Amazon is priced only close to $3,300 as of last close. So to make better sense of this number, we need to have an understanding of the fundamentals of Amazon and make sure that it is indeed that strong of a company to give us the confidence that it can net us such a high intrinsic valuation. How we derive this number is due to the inputs that we entered over here. And of these figures, the two that have the largest impact on the intrinsic value comes from the cash flow from operations as well as the growth rate. And guess what? These numbers are gotten from the financial data of the companies. And that's right, we are back to fundamental analysis. So that's why it is very important to first conduct the fundamental analysis first to make sure that the company we are valuing is strong and is growing consistently before calculating the IV. Otherwise, we can get a company that is extremely undervalued, but it doesn't make sense at all if it can't fulfill the numbers that we input into the column over here. If you find today's content helpful, do remember to smash the like button and subscribe to the channel for more videos like this. To conduct our fundamental analysis, we are largely going to rely on the website roic.ai. Over here, they have a wide range of financial data lasting all the way from when the company begins. The first step in the analysis is to make sure that the company is profitable and bringing in money. Next, we want to also make sure that it has been growing consistently in the last 5 to 10 years. If the company can fulfill this, then at least it gives us some form of confidence to the value that we input into the calculator previously. So for this step, we are going to just look at 3 figures. First of all, we want to look at the revenue, followed by the net income, and lastly, the cash flow from operating activity, all the way down at the bottom. So these 3 figures tells us how much the company is making and whether the company has been profitable or at a loss for the last how many years that you are looking into. So it goes without saying that these numbers have to be positive, meaning to say that the company is making money. And not only that, these numbers should also be increasing consistently and continuously for minimally the last 5 years. That would mean from 2017 all the way to 2021. It will be even better if the company can show an increasing profit in terms of revenue, net income, and cash flow from operations for the last 10 years, lasting from 2012 or 2011 all the way till 2021. So for Amazon, let's take a look at it. The bar chart shows us very clearly that the revenue has been increasing exponentially the last 10 years. The net income is slightly small to see, but at least the cash flow provided by operating activities has been growing consistently as well, barring the slight dip in 2021. So let us take a closer look. For net income from 2015 onwards, it has been increasing consistently from 600 million to 2,000 million, 3,000 million, and all the way to 33 billion last year. Alright, so no problem with that. Minimally, we have seen a consistent increase for the last 5 years. And for the cash flow from operating activities or cash provided by operating activities as labeled in the website, there is no problem with it as well. All the way lasting back to 2009, we can see that the number has been increasing very nicely. Only for 2021, there is a slight dip for certain reasons that I'm not very sure of. So to find out more about this, we will have to dig further into their earnings report. Okay, so very simply that concludes the first step of our fundamental analysis. We have already ensured that Amazon is a strong company that has been growing continuously since the last 10 years at least. So the first step gives us the confidence on the growth rate that we use for the analysis and the calculation. Next, we want to ensure that the company does not have too much debt as well. So to check out the debt levels of Amazon, we are first going to rely on the current ratio. For current ratio, we can get it from Finviz, and it is over here. Current ratio should be more than 1. and for Amazon it is at a figure of 1.1. The next ratio that we want to look at is the debt to EBITDA ratio. So EBITDA can be gotten from here. Basically it stands for earnings before interest, taxes, depreciation and amortization. So for EBITDA, for the last year 2021, Amazon is having an EBITDA of 74 billion. Now, what's the debt that Amazon has? For that, we are going to use the total debt that we have already calculated when doing the intrinsic value calculation. So the total debt, long-term and short-term debt of Amazon stands at 116 billion. That gives us a ratio of about 1.56 or 1.57. So is 1.56 considered a safe level of debt to have for a company? So generally, the net debt to EBITDA ratio of less than 3 are considered acceptable. Right, ratios higher than 3 or 4 serves as red flags and indicates that the company may be financially distressed in the future. So therefore, we can rely on a ballpark figure of 3. Anything more than 3, we can say that the company is having too much debt and could be risky. Right, but note that they are using net debt to EBITDA while we are using debt to EBITDA. So what's the difference over here? The net debt to EBITDA ratio basically takes the long-term and short-term debt and minus off the cash and cash equivalents of the company. In our calculation, we totally ignored this and just look at the long-term and short-term debt. So in other words, you can think of our debt to EBITDA ratio as something that is more conservative. If your debt to EBITDA can be less than 3, then definitely your net debt to EBITDA will be less than 3. So when the company has debt, then the next thing to take note of would be their interest payment on the debt itself. And the next thing you should be concerned about is whether the company makes enough money to pay off the interest expenses. And this is what we call the debt servicing ratio. To calculate the debt servicing ratio, we want to look at the interest income and expenses of the company and divide it by the net income of the company. Interest expense is at 1,800 million, income at 448. So we will net this off. That basically gives us 1.4k million in terms of interest expense that they have to pay every year. And then they are making 33,000, so divide by, and this is a 4% debt servicing ratio. So this is generally alright. What we are looking out for is a debt servicing ratio that is less than 30%. All three figures that we have looked at so far tells us that Amazon is currently having a safe level of debt. And on top of that, they have a similar amount of cash and short-term investment in the form of liquid cash for them to deploy as and when they like. And that is all we need for a very simple fundamental analysis of any company. Right, and couple that with the intrinsic value calculation, I hope that this gives you the confidence that Amazon is still a very strong growth company, and it should also hopefully give you the confidence in the growth projections that we used, and therefore I hope you are convinced that Amazon is still currently very undervalued, even at $3,300. If you have any questions or comments regarding the analysis that we have conducted, feel free to leave them down in the comment section below. Currently, I have 3 shares of Amazon with an average purchase price of $2,300. At a price of $3,298, I'm currently at a 41% gain. And for me, I'm looking at accumulating my last 2 shares of Amazon before the share split. So that after the splits, I will have 100 shares I can sell covered cost on them. Ever since we have done the intrinsic value calculation video, stock prices has rallied tremendously and very strongly. It is currently at the 150 moving average, seemingly to have met some form of a resistance. So whether or not this is indeed the resistance, we will have to wait and see. Nevertheless, prices are at a temporary high right now at $3,300. Therefore, now might not be that good of a time to accumulate your shares. A good time would be perhaps to wait for it to correct slightly down, maybe to the exponential moving average, and that would maybe corresponds to a price range of maybe $3,038 to about $3,078. Hopefully, I'll be able to get my last 2 shares by then. Alright, and with that, we have come to the end of the video. Let me know your thoughts about Amazon as a company and as an investment. Will you be getting into it yourself? Leave a comment below. Do remember to support us by smashing that like button and subscribing to the channel. Thanks so much for watching, and I'll catch you in the next one. Goodbye.